to sell breakdowns and look at some of the bear cut patterns on the open that can produce profitable trading opportunities. Okay, the first bullet point, bear cut patterns on the open. Here's two quick examples. Cisco, you can see it gapped up 20.3 up to 20.8. Again, as a most active, this isn't the type that I generally trade, but it does have the right pattern to show y'all. Gapped up and made a bear cut pattern. The short trigger would be once it's lost that, say the 20.5, 20.6, and we'd expect to cover down here. And this is a 2-day chart near the previous day's high resistance. This would be the first place that I'd be looking to get out of the stock. Turns out it kept on going down, but this would be the first place that might get a bounce or might get support. So this would be close to a half point on this kind of a short. Just to put in perspective, here's the intraday chart. If you're just looking at intraday charts, I'd strongly suggest that you look at the 2-day charts as well, because it really helps you to put things in perspective and anticipate reversals and Fibonacci pivot points, that kind of thing. So you can see got some selling. Our trend was down from the open. I typically like to short at the 0.5 to 0.7 underhole numbers, so that would be here, and I'd probably be covering here around 20.2 or 20 on the way down. Another example, IDTI. Put it in perspective, 2-day chart. Stock closed off previous day at 39.6, gapped up today to about 40.2 on the open. Made a bear cup right here. Short entry would be under the decade, 39.6 or so, 39.5. You can see on the chart here, that's the support line that we look to get in short under, and that would be around 39.6 or so. Cover down to here in the chop around 39. So that's another half point clip. And the way to identify this again is we see a gap up, didn't make a new 2-day high. Again, our long signal would be, if I was just watching the stock right from the open, I wouldn't be long in this stock until it made a new 2-day high up here. Okay, we'd look for a short as soon as it makes a bear cup and starts to lose it. The very best short, of course, would be under the 2-day support, but we're not going to lose 3 points in the pre-market immediately, so we look to get in early on a short here. My trading style is short right here, cover here, that would be down here, goes into a consolidation range here and doesn't lose it till after lunch. Next short would be at once it's lost that previous support line here, say the 38.6, and we trail a close stop. I'd probably be at around 38. I wouldn't have gotten the 37.6 out of it. You never get the whole range out of a stock. You're just looking to clip parts of it. Maybe it's a half point, 3/4 of a point. If you're fortunate, maybe it's a full point or 1.25. But typically it's good to take halves to 3/4 on your wins and 0.2 to 0.3 max on your stops. You want to maintain at least a 3-to-1 risk-reward ratio, all that kind of stuff. So again, you're trying to capitalize on parts of the moves and use the support resistance lines to time that. Let's take a look at fading the 10 o'clock tops, hanging off a cliff chart patterns. These are interesting. These are good to know. Let's look at IDPH. Here's a 2-day chart. You can see the stock again made a bear cup on the open. This one's starting to lose it. And 10 o'clock is typically a good time to look at for reversals and continuations. 10 o'clock's where a major trend is usually established for the stock each day. You get your 10-minute reversals up, down, chop, down, 10-minute reversals. After 10 o'clock, though, it makes a small bear cup, and that's our support line here at the 51.5. Short that, and I'd probably cover around the 51. Again, I wouldn't get all the way down to 50.6 or something, but I would get, the half point on this. The next short would be after the next bear cup, right? And you see that there, continues on. Let's take a look at VeriSign. Another really good example. 10 o'clock is a good time to watch. You can see it got some buying on the open, sold off a bit. And this is our 2-day chart. We zoom into our half day, and you can see our support line here is right at the 56.5, and again, this produces the place where you look to short right after 10 o'clock. So this is 10 o'clock. The stock's continuing down. It's been in a downtrend ever since the open. Got a little bit of buying until 9:35, but it's been making lower lows, lower highs. Even if you look closely, you can see a descending triangle right here. Anyway, so if you can get off, get an uptick, get a short off an uptick here under the 56.5, that gives you your signal. When it goes back into a technical uptrend here on a bounce, that's where you get out. I typically would never hold the stock for this half hour and hold through all this chop. I'd be out at the first sign of trouble, and that would be when it starts to get buyers back here. Okay. Let's see, one more example. Let's take a look at the third bullet point, shorting 2-day low breakdowns, your best short trade. And these are really important to learn. This should be in every trader's playbook, just like our 2-day high breakouts that we discussed earlier in the tape. Here's our 2-day low breakdowns, 2-day of eBay. And again, what you do every day is pre-market, before this day even opens up, you're looking at the previous trading day and identifying the high and the low and where you're likely to short that stock if it travels there. Okay, now occasionally you may get a false bottom and take a stop on it, but that's why I typically place the short trigger at about half a point under the previous day's low, and that keeps us out of the noise range. So you'd get a piece there. The next short signal would be under this bear cup, which would be down here around 60.5, 60.4. It'd go down to 59.8. I'd be at around the 60, so take another half point on that. So you can see, take a half point here, take a half point there on the shorts. Okay, let's take a look at Millennium, another biotech stock in the trading basket. Two-day chart here. Here's the support line. It's a short under that, so you could short this stock down in this range. This one's really choppy, so you may not get as much of a clip, a half point or greater win, but you can see that if you're swing trading or holding for longer term, certainly this would be good. And usually it's great for day trading too. You're looking for a stock to lose the 2-day support. Another example was IDPH from earlier. You can see the 2-day low down here anywhere is great for short, and lost a couple of points from the 51 support line. This is the previous day. This is current trading day. Could be short here, say the 55, 56, cover down here, short again. And again, you're looking at micro support and resistance. Short once it loses this again. If you're trading the afternoon, take another half point out of it. Okay, now let's look at the fourth bullet point, descending triangles and consolidation breakdowns. In the half-day chart, we're going to start off by looking at Veritas, VRTS. Now, what do you see about this chart? For a day's unfolding, during this time, it's in a choppy range. There's no trading signals being generated by the stock in this trading range. So what you're looking for is the first sign of a breakdown. If this is, for example, this is to simulate what you're seeing during the trading day. The stock's doing this, it's doing this, it's not giving you any signals. You know that you'll go long if it gets up over here, right? And you'll go short if it gets down here. And that's what you should be looking for. And sure enough, that's where the stock starts to lose it. It's around 1:15 in the afternoon. And if we take that back out, you can see, sure enough, we shorted the 43.5, 43.4. That produces, close to a 3/4 point win on the way down here, right? So that's the way to correctly identify the short, is to look at the consolidation point. Let's take a look at another example, MERQ. Same story here, right? We see the stock test and retest this bottom. This makes also what's called a descending triangle pattern. It's lower lows, lower highs, but holding firm on this support line at the 40. And you see this happen frequently for decade numbers. So you're saying to yourself, you're patiently waiting all day on this stock. And generally, like I said, I only like to trade the open, but if I were trading this stock all day, I'd say to myself, I'd short it once it loses this support line down here. So try to get off a short into an uptick down here around the, it loses the 30, so say the 39.5, 39.6, and you could cover later on in the session, take a piece out of the range here and cover at one of these bottom bounces and take a profit out of the stock. So that's a descending triangle. Let's take a look at a couple other examples, just to make sure everybody has it clear. This is open wave. Again, you're always looking for support, resistance, and where the stock's breaking down and what kind of story is it telling you. So, I'm always sitting here quickly drawing support resistance lines and looking for things like pennants and flags and channels and so forth, and firing off the trades based on that. You can see here, I wouldn't be short 26.2. I'd wait for it to lose the whole number under the 26, say at the 25.5, 25.6. That's typically where I like to short. Under the whole number, around half a point, maybe 3/8 of a point. That's 0.7 at the 0.7 here. and you cover at the first sign of a loss of the trend here down here, the 24.8, and again take a nice clip out of the stock. So descending triangles tells you that sellers are slowly winning the battle, and it's just a matter of time before it breaks down. You wait though, you don't try and enter early, you wait until you get a confirmed breakdown under the support line and fire off a short there. And a final example for shorting, we can take a closer look here at eBay. Here's the 2-day chart. Again, that's our support line. We look to get short down here as it loses it. The way to time this, you're always looking for a short under a previous low. So I'm not going to try and short this stock in here. I would not have correctly identified this short on the way down. I'd rather wait for it to lose the previous low down here. So this would be, say a 65 or so, 66. It loses it here. And again, sometimes, you'll short it here and it'll only go down a little bit before it starts to get buyers again, and you stop out even or 0.2 cover stop loss, and that's not a big deal. You're not taking much of a loss on it. But you try again. You set the support line here at the 66 and get off your short here on the uptick at the 65. Cover down here at the 59.8 or the 60, which would be where I'd probably be covering around 60, and take your 5/8 win out of the short down here. So this strategy, you'd probably produce if you waited till the 60.5, you wouldn't have been in short, but if you did short, say 66, and cover out, you'd cover a stop loss there. You try again here at the 65, and that would produce a big win. So you get net profit on the 2 short attempts. So again, that's a good strategy to look at for managing your shorts. Always looking for it to lose the previous day's low. And like any of these trades, there will be times where it will lose that and then promptly retrace, okay? And in that case, you take a small stop loss. If you're a fast trader, say if you shorted 61.5, it goes down and it starts to come back, you could cover and double, or cover and reverse too long, in other words. Let's say I was short 400 shares here at 61.5. I got down to 61.2, started to come back. Let's say I went ahead and covered out and either took a small profit or got out even. I could go back and go 400 additional shares long, so I'm net 400 plus on the way up, and I would cover out at the previous, rather sell out at the previous top here at close to 62. So that's another way to manage it. If you're in short and the stock promptly reverses on you, you can always cover with an order, a buy order that's twice your short order. So let's say I'm short 400 on the way down, it's starting to reverse. I go ahead and put in a buy 800 shares so that it covers my first 400 short, and I'm net 400 long in the stock, and it gets a bounce. Okay, so that would be another advanced strategy for how to manage your shorts. If they turn against you, or you get a short squeeze, or bounces up, not only do you cover, but you buy additional shares long to recapture your stop loss and take a profit on the stock on the way up.